And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show. I'm Mike Harrison, and as always, we're working on your financial freedom. There's an old saying amongst investors, a rising tide floats all boats. Let's think about 2010 to 2022 for the most part. The general investing of the stock market, real estate, pretty much everything that you wanted to invest in, Bitcoin, that sort of thing, but all grew substantially during that period. Sure, there was the occasional hiccup here or there, but for the most part, everything excelled. Even COVID year, 2020, I believe at the end of the year, the market was up 23%, which is insane, and we're learning that was insane, right? Didn't make any sense, but that rising tide floats all boats. Essentially, what that says is you don't even have to be very good at it. All these conditions are making it all great. And so what happens is people end up getting really reckless, right? They stop paying attention to maybe some of the fundamentals that they should have been paying attention to early on. And we're going to talk about that on today's show. And we're also going to contrast that with some things that we teach here at Lifestyles Unlimited to essentially mitigate that risk, some items to pay attention to as you invest out there. You see, Warren Buffett, the Oracle of Omaha, the man that owns Berkshire Hathaway, Fortune 10 company, not Fortune 500, Fortune 10. His company is up there with Google, ExxonMobil, Amazon, Walmart. You see, Warren Buffett's pretty darn good at investing. In fact, he might be the greatest investor in American history, if not world history. And you know what Warren Buffett says? He says it's only when the tide goes out that you learn who's been swimming naked. What does that mean? Well, I think the tide started going out about mid-2022, and it continues to go out today. We've got inflation that's off the chart, and it's not 8%. Is your grocery bill up 8%? Because I know mine's like up 40%, okay? Gasoline, electricity, gas to your house, everything's up. Vehicles are up. So we've got this inflation. What else do we have? Got some really high interest rates. So you combine those two market forces with some of these reckless investors out there, both real estate and stock market, and we're going to talk about real estate here. And you're going to see who's swimming naked. You're going to see who the smart investors are and who maybe the careless daredevils are. And it's true. It's out there. We're learning who's really good and who's not so good. And I'm proud to say that Lifestyles Unlimited, that our training, our lead investors, our passive investors, we're excelling. We're doing well. Are there some tight situations out there? Sure. But nothing like what I'm about to share for you in this first part of the show. And what I'm going to share is actually a horror story. And I'm going to explain this failure both from the syndicator and from the eyes of the passive investor. And then, like I said, I'm going to talk about lessons learned and ways that we insulate ourselves from disasters like this. And what am I talking about? Well, I'm talking about a giant foreclosure, a failure in Houston, Texas, very close to home. Why do I want to talk about that? Let's get to the why. Okay, the best way for me to explain this to you is let's take an analogy, and let's take us as investors in multifamily apartment communities, and let's say that we are all passengers or captains of seagoing ships, okay? And we're constantly the ocean back and forth and across through all sorts of weather, good and bad. And we're seafarers. And all of a sudden we get word that 4 giant seafaring ships sink suddenly and all life on board is lost and the cargo is lost. If you're a seafarer, wouldn't you want to learn why those ships sunk, what caused it? And that way you can then apply the lessons learned to what you do as a seafarer and get better at it and insulate yourself and protect yourself? That's what I want to do. So when I saw this story, of course I wanted to dig into it. Of course I talk about other passive investors and lead investors about this. Yes, this is news. So there is a group of syndicators pretty much everywhere outside of Lifestyles Unlimited. I'm very proud to say this is not a Lifestyles Unlimited syndicator. Never was. We're not affiliated with this person in any way, shape, or form. You can go to the Wall Street Journal, April 11th, 2023, so just a couple of months ago. Okay, so I think there's going to be more of this, but the title of the article is Houston Apartment Owner Loses 3,200 Units to Foreclosure as Multifamily Feels the Heat. And this is by Will Parker and Conrad Putzier. And Conrad, I hope I'm not saying your name wrong, but I do want to give credit where credit's due. So what they're talking about is values are coming down, interest rates are rising, and rent growth is slowing. So let's share what happened here. So this was a company called Applesway Investment Group, if you want to look it up. Apples, right? The fruit. Apples, Apples. Applesway Investment Group borrowed nearly $230 million to buy the buildings with more than 3,200 units as part of a Texas buying spree during the pandemic. Okay, so essentially this guy's name is Jay Gajavelli, and this guy's buying when we were selling. Okay, so Del Walmsley a year and a half ago is screaming from the mountaintops, it's coming. You need to sell your dogs now. Get out of bridge loans. Do not get into bridge loans. The interest rates are going to go up. And I almost want to say to this guy, I mean, he bought, did he not see who got elected? I mean, you knew interest rates were going to go up with all the money that's just getting printed. And, of course, there's another debt agreement that's been in the news lately. And, you know, at the end of the day, all they do is they tell the poorly informed person, we reduced the deficit. You didn't reduce the deficit. You added another $1.5 trillion of spending. That's not reducing the deficit. It's like me going out and buying a new F-250 Ford truck for $95,000 and essentially maybe buying the one that was $10,000 cheaper than the other and then coming home and telling my wife I saved $10,000. No. So they're still going to print another $1.5 trillion. And everyone wonders why interest rates keep ticking up and keep ticking up. So this guy was buying properties and essentially he was banking on surging apartment rents. He was utilizing the cheap debt, which he thought would continue on, and the cheap debt pushed the property values to record highs, and people were still willing to invest and pay record high prices for buildings that essentially, if you're just going in and betting on raising the rents and you're not bringing any value, which is what we do here at Lifestyles Unlimited. We teach best product, best price. You should catch my show last week. It's with a lead investor, Holden, and all we did was talk about how he's bringing value, how he's making it a better place to live. But that wasn't what this guy's plan was at Applesway. He thought he'd just buy it and raise the rent, and he was living pretty reckless. He's swimming naked as the tide goes out, and everyone found out, and it's a sad story. It was a $230 million crash. Obviously, he lost money that he invested in the deal. Passive investors, they all lost their money. It's all gone. Part of this is they're buying at these bridge loans, and then those loans are resetting at higher rates. Now, you can get what's called cap insurance. And let's say you do have a bridge and it's an interest-only period for 3 years, and you have a cap insurance policy that you purchase. And what that is it basically says, hey, when this loan resets, it can only reset at this level, and you want to bake that level into your property and make sure you're still cash flowing. So that's there. But I don't think cap insurance was ever purchased because this guy essentially within a year and a half or less on a couple of these properties crashed and burned. Okay, he's buying in mid 2022, and he's buying multi-million-dollar properties. I don't know what he was thinking on it, but I don't know the answer if he had cap insurance or not. But for these to go under so quickly probably tells me the answer is no. But like I said, I don't know for sure. Now, rent growth. Let's talk about that. That complicated this deal as well. rent growth is not at the same rate. There's still rent growth, okay? And I'm going to talk about rent growth within two different aspects. One, I'm just going to talk about, say, generic rent growth is still increasing in the right markets. If your property's in the right location, very important location, and it's in the right market, and it's a strong economy, and there's jobs, and people are working. There's still kind of fundamental rent growth, but it's only maybe 5, 6, 8% out there compared to what it was in the past. You were having 15+% in many markets all across the country. So it's a little more segmented now. And then there's kind of the rent growth that you can command if you bring value to the deal. Now, Mike, what does that mean? So let's go in and say I buy a property that's distressed, right? There's deferred maintenance, there's leaks in the roof, the pool is green, and it's just, it's nothing more than a nursery for mosquitoes and God knows what else. And it's just the parking lot's beat up, and there's junk cars and broken, boarded up windows. We buy that place and we start fixing everything, right? We start fixing the air conditioners. So we fix the parking lot. We put superior lighting in all the areas, so there's no dark spots. We've got LED lights. We put low flow toilets in. We fix the pool, make the pool a super nice place. We put some grill stations outside. We put a dog park in there and a dog wash, right? How great is it if you can have a dog park and this really tricked out dog wash? I know a lead that built the coolest. I was jealous. I want one at my house. I mean, it's got a metal R-panel roof, and you walk in and it's got the cool sink where the dog can kind of walk up on it, and you put the dog in there. It's got the industrial kind of spray brush and everything else, and then it even keeps the soaps and shampoos for the dog there. Heck yeah, if I lived in that property, I'd be using that all the time. But I think I have to pay. I don't know. My wife gets my dog trim, but those of you out there that know, I mean, you're looking at $80 to $100 per dog. But if you got that installed there, are you building value? Yes. Is that a place that I would like to maybe pay a little extra to live at? Yes, it's clean, it's functional. We got cool flooring, we got new paint on the walls. But this investor in Houston brought zero value. How are you going to raise essentially the rent on people? People aren't dumb. You can't raise my rent if you don't give me a reason to raise my rent. I understand, these market adjustments, but you can't go up $500 or $300. No way. My name is Mike Harrison. We'll be right back.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
There is a dream killer here somewhere today. You're going to run into somebody that's going to tell you this stuff doesn't work. Like Vinette said, it's a scam. This is probably a multi-level marketing program. Somebody is going to tell you it doesn't work because you're the wrong race, the wrong age, the wrong sex, the wrong sexual preference, the something or other. That this is all set up so rich people can be successful and all you poor people can't. And if you believe that, they've won. But if you don't, you win.
Don't believe the dream killers. Start winning today with the Lifestyles Unlimited free workshop. Get the knowledge you need to replace your income in 2 to 5 years, and then find out how to take action. Register for the free online workshop at lifestylesunlimitedworkshop.com.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the show. I'm Mike Harrison. I'd like to throw a little challenge out to you listeners out there. If there's a topic in real estate investing that you'd like me to discuss on the show, send me an email. In the subject line, put show topic in the subject line. And just tell me what you'd like to learn more about or what you'd like to talk about. Or if you just have a real estate question, send it to me. And if it's something I can address on the show, I certainly will. But either way, I'll respond to you personally. Today I'm talking about this Applesway Investment Group in Houston. In April, they foreclosed on $230 million So the bank got hit, or, well, I don't think it was a bank. I think it was maybe a private bank. Yeah, it was a bank in some form. Obviously, there's a lender there. Maybe it was an investment group that lended to them. I'm not sure how that side of it works, but they've got a property that's they've got to sell at a discount. Obviously, the lead or the syndicator, a lead investor, that's a title for a Lifestyles Unlimited person. This is not a Lifestyles person in any way, shape, or form. And I'm going to tee up why they're not Lifestyles, why we would never have gotten in on a deal like this, just here in a few moments. But essentially, this guy, he lost. But his passive investors, I feel for his passive investors, if he's buying, if the lender's bringing 230 to the table, there's probably 100, maybe close to that million that was raised, maybe more than that. I don't know. Again, I'm not involved in this. That was raised to these poor passives, probably all over the country, that are betting on this guy. So what went wrong? Let's talk about that. So Applesway is the company again, APPLES Way. They originated their loans in the second half of 2021 and early 2022. These folks were buying when most of us were selling. Okay, I'll just say that right there. I know that for a fact. Dale Walmsley came out early on before interest rates even started going up, and he said, "It's coming. Sell your dogs now." I had so many properties sell in 2021, it was a mini fortune that came my way. Now I redeployed those back into new properties. So there were buying opportunities, but the metrics that we were utilizing were essentially insuring us against this sort of thing. We'll talk about those here in a little bit. Now, I was reading the article in the interest rate. So this Applesway interest rate had a loan essentially originally at 3.4% to around 8%. So it was a bridge loan. It was shifting. And so if they're barely cash flowing at 3.4, or maybe not even cash flowing, a lot of times you buy these deep value plays, you're baking in 1 or 2 years that you're not going to cash flow because you've got to essentially do the lift and change the metrics of the apartment. I don't think that was this guy's model in any way, shape, or form. I think his model was, I go in, I raise rents, we make money. But at Lifestyles Unlimited, we're going to raise the rents because we're going to bring some value to our client. And our client is that resident of our apartment community. He bought an apartment complex. He's a landlord, and he doesn't care about his people. 3 things that we don't do. So he also financed at about 80% debt, so very, very high leverage. So no opportunity to refinance, right? You know your ship's sinking, and you could refinance maybe into a fixed rate, but the banks are looking at it and they're like, "Hey, Broheim, I know I loaned you 80% originally, but in case you haven't looked around and noticed what's going on, we'll give you 50% this time around, or 60%. There's no way he could refinance. And again, looking at the pictures of these properties, I doubt they were cash flowing. This was only a year and a half. I mean, this thing didn't even, I mean, if it's a ship sinking, it went down in a matter of minutes. You know, it didn't even, there was even probably not much of a sign. It was kind of wham, bam, we're out of business. Now, what else did this person do? Again, from information, I don't have personal knowledge of this deal. I just read the article, and you can read the article. These were huge complexes. I mean, 600 units or more. And I would say at least, I mean, for the most part, that is very rare in Lifestyles Unlimited. Do I know a couple of people that bought really big places? Yeah, and they did their thing, and they got out, and they go, I'll never do that again. 600 units, you probably got to have 4 managers. You got to maybe have 6 or 7 teams of maintenance crews. If you're following a Lifestyles Unlimited model, think about all the make-readies that you're doing. If you just have a 10% turn of any given month, that's 60 units that need to be made ready. Again, this other guy, he didn't. I know he didn't follow our model, so not anything he cared about. But we, for the most part, stay away from giant complexes. Like I said, it's a miniature city. I mean, it's got its own centrifugal force, 600 units. I mean, that would be very, very hard to turn using the Lifestyles Unlimited model. Now, what else did this guy do wrong? He was in just the best way to say it is a very poor part of town, okay? Again, not what we necessarily teach here at Lifestyles Unlimited. We've had some lead investors that have done just fine in some very downward parts of town, but I'll tell you, our model really is we want to be in a decent working class area where we can take a poorly maintained, a distressed asset, turn it into that best product, best price. But we want to be in an area where there's abundance jobs, the schools, the kids got good school opportunity. We don't want to be in a high crime area because while we can't prevent crime, we're going to do everything we can to make our product the safest that we possibly can. And again, we're screening our resident. If we're going to have the best product, best price, we're going to want the best resident. Okay. Definitely. So we want good people in good, clean, functional place to live. So I didn't see any value add with this guy. Where were the amenities? How was the pool? There's a picture of the pool on the article and it's green. No, it's that summertime, man. We want to hang out at the pool, fix that pool, put in a dog park, change the lighting, put in the low flow toilets. When that property turns, go in there, paint everything, put new carpet in, put hardwood, vinyl plank, flooring in there, resurface the tub. If it calls for granite, put granite in there. Maybe have different levels of lift. Here at Lifestyles Unlimited, we'll teach you 28 distinct ways to better that property and increase the value. Our leads follow the white paper. There are requirements. There are best practices that our passive investor, we teach you. We have an entire passive investor certification that we're going to put you through, and you're going to learn these items. You're going to understand these best practices. You're going to be able to ask these questions. You're going to be able to apply these best practices to the deal and see that they are being followed. So essentially, Lifestyles Unlimited teaches our leads to be great apartment operators, not just acquisition specialists, right? You can go get on the internet and type in multifamily investing, and you can go find all the acquisition specialists you want out there, okay? And why don't you follow that Applesway Investing too and see, he's part of an investment group in Houston. And if you're on the outside and you're not a Lifestyles Unlimited member and you're looking at Group A and Group B and Group C, I invite you to take a hard look at Lifestyles Unlimited and understand how we're different from these folks. Now, what do you need to follow? All right, let's just talk about some things that you can take action and some lessons learned. One, follow what you've learned in our education. Talk to your mentor. Understand that. Talk to other passive investors. Do not invest more than the lead investor or sponsor. Some of these Wild West groups, these guys won't even put any of their own money in it. Can you imagine that? Can you imagine buying a $60 million apartment community and the lead investor doesn't have 1 red cent of their own money in that? I'm telling you, this stuff happens. It's out there. Again, you can get online, type in multifamily investing. You'll find those folks, and they're gifting themselves a portion of the ownership. They're making money on the acquisition fee, and they've got a construction fee, and then they've got they take an extra share than different shareholders. There's all kinds of bad stuff out there. So, one, don't invest more than the lead investor sponsor. If they're not investing in the deal, you probably shouldn't invest in the deal. Here's another one. Do not invest a high percentage of, let's say you have, $1 million to invest in passive deals. Wouldn't that be great? Don't go give $500,000 to just one lead investor, no matter how good they are. Spread it around a little bit, okay? No matter how much you like them, that's 50% of, I'm not saying don't give $500,000 to one lead. Maybe you do that, but if you got a net worth of $5 million, that's 10% of what you're investing, sure. But you don't want a high percentage, what I'm saying, of your overall investable funds with one lead investor. I did find myself in that situation. It's happened to me personally. How? One, I had a deal we actually did a 1031 exchange on an apartment community, and it doubled my money. And I had a high amount of money in that initial deal. It doubled 100%. We 1031'd it, and first world problem, right? And then I also had 2 other investments with that lead. And essentially I wake up. Now, this is a couple of years ago. Things have changed now. But I wake up and I'm like, holy cow, I've got a large chunk with one spot. So you need to spread that around a little bit. Here's another thing I want you to do. Spread them around by location. Pay attention to risk. I mean, weather events, right? You may be from Corpus Christi and you think that's the greatest place in the world. And so, I'm going to invest in Corpus Christi. It's growing. There's a lot of businesses coming there. In fact, Tesla is going to build a battery plant. I think that's another 5,000 jobs. They're building a LNG plant. I'm invested in Corpus. I'm not all invested in Corpus. Now, weather events, what happens on the coast? Hurricanes, right? So maybe we don't want all of our money down there, no matter how much we're in love with that area. What else is a factor on the coast? Insurance, right? Insurance, it constantly is going up, especially on the coast. So spread your money out. What's another thing you need to be aware of? Well, you need to be aware of the legislative power within that city, because they will shift. There are certain cities that I just won't invest in. Flat out, I don't care. You may have an offer and it's going to 15% cash on cash return, and you're projecting 100% return on a refi within 3 years. But if control of that city is not pro-business, is not pro-property rights, no, I'm out. In fact, if I've got money in those areas, if you haven't gotten it out already, get it out now, okay? Get it out now. Understand the business plan of the deal, okay? It's interesting that a lot of new passives, let's say, they're kid in a candy store, and I've been here. Hey, I've got money. I want to get it into passive deals, and they're just, here's some for you, and here's some for you, and here's some for you, and maybe they don't understand the business plan. Maybe that lead brought it forward, and it's a 10-year hold, and you didn't know that going in. Or maybe it's a deep, deep value play, and it's not going to pay for 2 years minimum. And, oh, I didn't know that. I thought we were going to get quarterly dividend. No, the business plan right here, it says, first 2 years, we don't plan on making a payment. Year 3, we'll look at the situation and see how it is. And if we can make a distribution, we will. But here's the plan for this property. It's amazing how many people don't understand that. You need to what is the plan for this property, okay? So you need to be also cautious of a lead investor or a sponsor, and they keep talking about how big they want to grow and how fast they want to grow and how many numbers of doors that they want to own under management. And when you're talking to them, it's like a race in their mind, like, hey, I want to get to this level and this size and this. And instead, they're not talking about that particular investment that you're looking to invest in. They're all kind of maybe talking a little more about themselves. I think that would be a red flag. So I hope this helps you out. My name is Mike Harrison. I'll see you next week. I want you to remember, it's not the money, it's the lifestyle.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.